If you have ever wondered how big the Forex market really is and why it moves so fast, this lesson is going to change how you see everything. Welcome to Nesh Trades, where we simplify Forex into simple lessons. Forex market size and liquidity. Alright, let's start with where Forex trading actually happens. Most trading takes place in what's called the interbank market. Now, unlike stock markets, the Forex market doesn't have a physical location or a central exchange. Instead, it operates electronically through a global network of banks and financial institutions. This is what we call an over-the-counter market or OTC. Because of this setup, the market runs 24 hours a day and is spread across the entire world. So as long as you have an internet connection, you can trade from anywhere. Now, in terms of size, the Forex market is the largest financial market in the world, with millions of participants trading every day. And when we look at the most traded currencies, the US dollar leads by a huge margin, followed by the euro and the Japanese yen. This shows that most trading activity is focused on the major currencies. Now, building on that, let's talk about why the US dollar is so important. The dollar appears in most currency pairs, and since major pairs make up most of the market, it plays a central role. That's why it's often called the king of Forex. Central banks and institutions around the world hold a large portion of their reserves in the US dollars, which shows how much trust there is in it. It's also widely used in global trade. For example, commodities like oil are priced in US dollars, and many international transactions are done using it. So, in simple terms, the US dollar sits at the center of the Forex market, and as a trader, it's something you always need to watch and pay attention to. Speculation and liquidity. Now, let's talk about what actually drives most of the activity in the Forex market. While Forex is used for international trade, payments, and hedging, most of the trading actually comes from speculation. This means traders are buying and selling currencies to profit from short-term price movements. In fact, over 90% of trading volume is based on speculation. Because of this massive amount of trading, the Forex market has a very high liquidity. Liquidity simply means how easy it is to buy or sell without affecting the price. In a highly liquid market like Forex, large trades can happen quickly with very little impact on price. However, liquidity can still change depending on the currency pair and the time of the day, which we'll cover later. So let's quickly recap. The Forex market is a global 24-hour market with no central location. It is the largest financial market in the world, with trading happening electronically between banks and institutions. We have also covered that the US dollar plays a dominant role and is involved in most transactions. And finally, most trading is driven by speculation, which is why liquidity is so high. Nice. We have just completed this lesson, and if you understood everything, that's a big step forward. If not, take a moment, go back and make sure it clicks. Now let's keep the momentum going. Next up, we look at how to actually trade Forex. You are officially getting smarter in Forex. Follow Nesh trades and let's keep learning together. See you in the next one.